Global markets are calmer this morning, with Bank of Japan officials reassuring that hikes won't happen amid all this instability. There was no smoking gun in New Zealand's jobs figures for a rate cut next week, and the Reserve Bank of India is set to hold rates today. That's coming up in our 5 Things in 5 minutes. And then, in our bonus deep dive interview, ANZ New Zealand senior economist Miles Workman analyses how Australia's relatively strong jobs market is attracting Kiwis across the Tasman again.
The increase in outflows of New Zealanders to Australia is as high as it's been since about 2012-2013, at which time there was the Australian mining investment boom, and which also was an employment boom, which caused a lot of Kiwis to migrate over to Aussie at the time.
But first, in 5 and 5 with ANZ. Markets were calmer overnight. At 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.2% and yields on US Treasuries were up 3 to 7 basis points. The Bank of Japan's Deputy Governor said the Bank of Japan wouldn't hike interest rates while markets were unstable. The Nikkei rose 2.5% and the US dollar gained 2% against the yen. It's back over 147 yen after hitting 142 a few days ago. Here's ANZ economist Bansi Madhavani.
That was followed by Currency Chief Mimura's comments that it is important that the FX rate moves in a stable way and reflects the fundamentals. He also stated that it's FX volatility what they focus on rather than absolute levels. These comments from officials have helped calm the market after sharp volatile moves that we've seen in the past couple of days. The swift manner in which yen appreciated suggested that markets were concerned about rapid rate hikes, but the officials are emphasizing that monetary policy shifts will be gradual and only reflect normalization of policy.
US dollar index was up 0.2% at 4 a.m. Sydney Melbourne time with that strength against the yen. But the Aussie dollar managed to rise. It was up 0.2% at 65.33 US cents, while the Kiwi was up 0.8% at 60.00 US cents, following stronger than expected jobs data yesterday. Number 2, New Zealand's unemployment rate jumped from 4.4% to 4.6% in the June quarter. That was lower than market expectations, but the same as the Reserve Bank's forecast. Employment growth, however, was 0.4%, and that was well above forecasts, softening some expectations built up in recent days that the RBNZ would cut rates next week. Here's ANZ senior economist Miles Workman.
Ultimately, the Q2 labour market statistics do not provide the smoking gun that the market has been looking for. And in terms of the balance of risks around when the Reserve Bank might kick off OCR cuts, I'd say that the Q2 data just moves that skew of risks a little bit more closely to our central forecast, which is for OCR cuts to start from November this year. There's certainly no sense of urgency in the Tier 1 statistics. So if the Reserve Bank were to make a drastic pivot and start cutting earlier than our forecast, it would have to be based on some expectation that the outlook is looking significantly weaker.
Number 3. Miles says there was nothing in the data to cause ANZ Research to rethink its call that the RBNZ will cut rates from November. He says measures like the underutilisation rate, which rose 0.5% to 11.8%, shows there is broad-based loosening in the labour market.
In big picture terms, it definitely suggests that there's more economic capacity out there, and that's for an inflation outlook perspective, that's certainly what the Reserve Bank wants to see. But as I mentioned, it's not really happening at a faster pace than the RBNZ have been expecting. Another interesting snippet in the data is the youth unemployment rate. So that lifted quite sharply. So for those aged between 15 and 19-year-old, that unemployment rate lifted from 15.1% to 20.7%.
Number 4. Thailand's annual inflation rate came in at 0.83% for July versus expectations of 0.7% and below the Bank of Thailand's 1 to 3% target range. ANZ economist Crystal Tan says the overshoot was due to higher food prices.
Today's data is not going to have much bearing on the policy rate outlook, especially when we have recent activity data suggesting that growth has tracked broadly in line with the Bank of Thailand's projection. The central bank is not going to be in any hurry to adjust policy rates.
Number 5. The Reserve Bank of India has a rate review today. ANZ economist Dhiraj Nim expects it to hold at 6.5% after annual inflation remained above 5% in June. He says confidence is needed that food inflation is falling before the RBI could look to cut from December.
Until those signs are clearly visible, we don't think the Reserve Bank of India will lower its guards. So I think they will maintain a hawkish stance, the rates unchanged. But one thing I'm quite keenly looking forward to is what will they announce in terms of liquidity, because the banking system liquidity has turned to a persistent surplus for various reasons. And if this liquidity surplus is large enough, that can have a bit of an inflationary consequence. But so far, they've been managing it well. The market would keenly watch if they announce any permanent tools to manage liquidity.
Diraj Nim there. Now, in our bonus deep dive interview, ANZ New Zealand senior economist Miles Workman analyses how differences between the New Zealand and Australian jobs markets are driving more Kiwis to cross the Tasman to Australia, and what kind of housing market they're finding when they arrive.
Migration is starting to turn very, very quickly. So we've had, after we've opened our borders after the pandemic, we've had a huge influx of net migration into the country, but that has certainly turned a corner. And one of the reasons why it has turned a corner is because departures are picking up very sharply. So over the past year or so, there's been about 140,000 people leave New Zealand, and of those, a little more than 85,000 were New Zealand citizens, and around half of those New Zealand citizens were going to Australia. So to put that into context, the increase in outflows of New Zealanders to Australia is as high as it's been since about 2012-2013, at which time there was the Australian mining investment boom, and which also was an employment boom, which caused a lot of Kiwis to migrate over to Aussie at the time. But what we are seeing right now is a very marked pickup in Kiwis jumping the ditch. So it's worth asking the question, what type of housing market are they leaving and therefore going into? Is it a case of out of the frying pan and into the fire? And that's sort of the question that we were looking to answer.
So what have you looked at? So, I mean, obviously there's lots of differences between Australia and New Zealand, the weather being one, but you've looked at the housing market settings. What are the main ones that you've assessed?
Yeah, so ultimately we've run through a whole list of differences and similarities between the two markets, noting that it is very difficult to make these types of comparisons, not only because of some structural differences between our economies. So we have different tax settings, for example, where the Australians have stamp duties and much firmer capital gains taxes put in place, whereas New Zealand just has the Bright Lines test, which is a very light version of a capital gains. But we also have quite different credit markets and macroprudential policies and the timings of all these. So very difficult to account for all of that. But one of the things that we did find is when we just look at the differences between the Australian and the New Zealand housing market, the variance across main cities is actually very, very significant. So for example, if you're comparing, say, Australian house prices, which might be up, say, about 35% from their pre-pandemic level, whereas New Zealand prices are up about 25% from their pre-pandemic level. But in Australia, the outperforming market versus pre-pandemic is Perth, and that's up 69%. And there's, lots and lots of variance. At the other end of the scale, you've got Melbourne and Auckland and Wellington, where prices are only up sort of 13% from their pre-pandemic level. So I guess the upshot here is when you're comparing New Zealand to Australia, there are these high-level data that we can look at to get a feel for, are house prices more expensive in one country or the other. But what we have found is that there's plenty of divergence by main city. So Sydney is by far the most expensive place to buy out of all these markets. What we did is convert median prices into New Zealand dollar terms and found that the house price in Sydney in New Zealand dollar terms is by far the most expensive. Canterbury was the cheapest. There was quite a big difference there between the Sydney market and the Canterbury market.
And so are New Zealanders, they're not just moving across because of the housing market, obviously, but how big a factor do you think it is in that decision?
So the factor driving migration tends to actually be relative labour market dynamics. So we're in a world where much of the global economy, including New Zealand and Australia and the US, is that we've had this huge inflation surge, and to get on top of that, central banks have had to tighten monetary conditions, and accordingly the economy is responding to that. But what really matters for migration is the Australian labour market versus the New Zealand labour market. Which one of those two is running a bit more stronger than the other, and does one bring opportunity versus the other? So fair to say what we're seeing with the migration data is it is a reflection of the relative labour market conditions, suggesting that New Zealand's economy and New Zealand's labour market is probably underperforming Australia's, and therefore explains why we're seeing this very sharp pickup in departures to Australia.
Miles Workman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, August the 8th. Catch you tomorrow with analysis of the Reserve Bank of India's rate decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.